Hi everyone, Friday, October 21st, it's time for 3 Things with Spyglass Lending, where we go a little bit deeper into the mortgage industry, not the usual headlines you hear about. We're going to take you behind the scenes as to what's going on with interest rates and what's going on in the mortgage industry. Let's get to it. Right behind me on the board, something interesting, something dear to my heart, and I'm going to explain why in just a moment. But let's talk about number one. Flip money is 10% plus right now. Well, what does that mean exactly? Let's start with this. I've been a private money lender and broker for going on nearly 15 years, so I know the space extremely well. I've worked with a lot of real estate investors, and I've worked with a lot of private beneficiaries and institutional funders who give money to real estate investors. Flip money at 10% plus again is a big deal. It's a bigger deal than a lot of people think, and I think even standard homeowners, sellers, and buyers should be thinking about this as well. The flippers of the world had it easy since about 2015, 2016, experienced, not experienced. They were being given money at little as 10% down, sometimes less in some cases, at like 6.5%, 7.5%, 8% money, interest only for the short-term loans to be, and including the rehab money, to flip a property. Well, now that money is gone. The cheap money is gone, and it's all the way back up at 10% plus leverages are down a little bit. Hey, 10% down or 5% down isn't cutting it anymore. Even if you're an experienced flipper, the expectation is you're going to be bringing in a little bit more down to do these deals, and you're going to be paying for it. And that's just the reality of what's going on out there, which brings us to number two. PM is 9% plus GI. Well, what does that mean? Private money is now 9% or even higher with guaranteed interest. Okay, so private money lenders love to give really low leverage loans, and I'm talking about private individual or a single family, small family office, as opposed to the institutional funders where you're going through the rigmarole of the underwriting process. Again, a private lender will give a business purpose loan on a non-owner occupied property to a real estate investor if the leverage is low enough, commercial, residential, whatever it is. A lot of times being used for refinance money, to take out money to do some other investment, some other project. Well, now, and again, that money was inexpensive as well, so as low as 6% in a lot of cases, 7% with a lot of private money lenders. Hey, they're expecting on their yield to get back 9% now, these private money lenders, even at these lower leverages. And not only that, again, the guaranteed interest, and this is a big thing as well. They used to just give it away and say, fine, you know what, pay me back quickly, whatever it may be, 1 month, 2 months, 3 months. Now, a lot of them want a minimum of 6 months return on their money if they're putting it out there for these 12 and 24-month loans. And they don't want borrowers just to take the money and expect that they can sit on it and turn it around or whatever it may be quickly or do that. They want to know that not only have they have shorter term loans, 12 months preferably, a lot of them don't want to be at 18, 24, 36 months anymore. They want to do 12 months, and they want guaranteed interest of 6 months because the competition is less for their money now, so they're allowed to say that. And this brings us to number three. Again, this kind of speaks to what we were just talking about. The LTVs are on their way down. Loan to value ratios for private lending. Again, this goes all the way back to here and to here, where for the flip money, you were all the way up at 90% plus in some cases, so as little as 10% down. For private money, you know, a lot of those lenders were pushing values a little bit. Most of their comfort level was 60-65% LTV, but they were doing 70-75% for a while. They had to compete. And again, they don't need to any longer. The loan-to-value ratios, the interest rates are going up, the loan-to-value ratios are going down even further. So a lot of these private lenders and a lot of the flip lenders and a lot of institutional funders are saying, lower it down. We're expecting homes to decrease in value. We're expecting that we have to play a down market now. So something, if you want a loan from me and you're telling me it's worth, a commercial building worth $1.5 million, I'm going to think it's going to be worth 1.2, 8, 9, 10 months from now, and I want to be at 60% of that number. So if you can stomach it, Mr. or Mrs. Real Estate Investor, that's where we're at now. So again, the private lending space really changing very quickly. And again, I think that's a huge barometer for what's going on in the rest of the lending space. Yes, we know about 30-year mortgages. Yes, we know about FHA, VA, jumbo loans, and what's going on there. But pay attention to what's happening in the private lending space. That'll tell you everything. These are the individuals who are really have been out there and often do risky loans. Well, they're becoming a lot more risk adverse. Thank you for joining me. 3 Things with Spyglass Lending. We'll see you again next Friday.